Welcome to today's Explainer, where we're popping the hood on EnerSys to find out if this fundamentally sound business is priced fairly right now. We're going to look strictly at the data, the financial metrics, and the historical performance of this nearly $8 billion market cap powerhouse to see exactly what's going on beneath the surface.
So, here is our roadmap for today. We'll start with their history of massive returns. Then, we're diving into profitability and cash flow, followed by financial health and debt. After that, we'll check out dividends and shareholder perks. And finally, we'll tackle the big valuation question. Is it overpriced?
To understand why this stock absolutely demands our attention, just take a look at this staggering 20-year total return of 1,717.92%. Seriously, numbers like this do not just happen by accident. They're the result of compounding business success over a very long period, reflecting an average annual return of 15.6% over 2 decades. That's exactly the kind of wealth-building trajectory that makes investors sit up and take very close notes.
Let's jump right into Section 1, a history of massive returns, tracking ENS performance.
For long-term holders, the upward trajectory has been just relentless, consistently multiplying investments over the decades. When you have a 10-year return of over 301%, that builds into a 15-year return of nearly 560%, culminating in that massive 20-year figure. Well, you are looking at the compounding effect in real time. It shows us a highly resilient business model that hasn't just survived multiple market cycles, it's genuinely thrived in them, rewarding patient capital every step of the way.
Now, what's really fascinating here is the stark contrast between a slight dip in 2024 and the explosive compounding growth we've seen in 2025 and 2026 so far. Back in 2024, the stock experienced a pullback, dropping about 7.5%. But look at how violently it rebounded. A massive 60.28% return in 2025, followed by a year-to-date return in 2026 of over 45%. This highlights some absolutely incredible recent momentum, pushing the stock up over 178% from its 52-week low.
Moving right along to Section 2, profitability and cash flow, the real engine of EnerSys.
These top-line macro numbers confirm we're looking at a multi-billion-dollar powerhouse that's generating massive amounts of free cash flow. Trailing 12-month revenue sits at a towering $3.738 billion. But, as we all know, revenue is just vanity if you can't actually keep it, right? Well, they bring $312.8 million to the bottom line as net income. Even more impressive, though, is the trailing 12-month free cash flow of $441.28 million. The fact that their free cash flow exceeds their net income is a tremendous sign of high-quality earnings and really excellent cash conversion.
Management's efficiency is clearly on display. Generating a 16.54% return on equity and over 14% on invested capital proves they know exactly how to deploy their resources. When a company can consistently earn a 14.24% return on invested capital, which, by the way, is notably higher than its 3- and 5-year historical averages, it tells us leadership is actively finding highly profitable avenues to reinvest the cash the business generates.
The crucial takeaway here is that nearly 30 cents of every single dollar remains after direct costs, maintaining very healthy profitability throughout their operations. A gross profit margin just shy of 30% shows strong pricing power and tight cost control at the manufacturing level. And by the time all operating expenses and taxes are paid, they're still walking away with a net profit margin of 9.26%. That is a solid, highly defensible buffer.
Next up is Section 3, Financial Health and Debt, where we examine the company's financial armor.
The company carries very little financial baggage. We're talking a debt-to-equity ratio of just 0.62, while boasting massive short-term liquidity, holding 2.75 times more current assets than liabilities. Basically, for every dollar of equity, they only have 62 cents of debt, signaling a very conservative capital structure. If a crisis hit tomorrow, that current ratio of 2.75, backed by a quick ratio of 1.72, means they could easily cover their short-term obligations without breaking a sweat. It's an incredibly sturdy balance sheet.
Let's transition to Section 4, dividends and shareholder perks, checking out those extra incentives.
They pay out a highly conservative 12.39% of earnings as dividends, meaning the vast majority of capital is safely retained to fuel further growth. The story here is all about priorities. EnerSys isn't trying to lure investors in with flashy, unsustainable payouts. Instead, they're taking almost 88% of their earnings and pumping it right back into that 14% return on invested capital engine we talked about a minute ago.
Now, while the 0.49% yield isn't going to make you rich overnight, the remarkably low 8.55% free cash flow payout ratio leaves incredible room for their streak of yearly dividend increases to continue. They've raised their dividend for 3 consecutive years now. And think about it, when a dividend only eats up 8.5% of the cash you generate, that payout is about as safe as it gets in the corporate world. There's immense runway here for future dividend hikes if management chooses to pivot in that direction down the road.
Finally, we reach Section 5, Valuation. Is it overpriced? Time to read the price tag.
When we group this alphabet soup of enterprise valuation metrics together, a very clear pattern emerges. Across the board, EnerSys is currently trading significantly higher than its own 3-year historical averages. Whether we're looking at enterprise value to EBIT, EBITDA, or sales, the current multiples are elevated. For instance, having an EV to EBITDA of 14.63 today compared to a historical norm of 10.32 means the market is currently willing to pay a much higher premium for the exact same operations.
The current price of admission is a PE ratio of 26.43, which is more than 60% higher than the company's trailing 12-month average. While their forward PE drops a bit to 16.84, that trailing figure of 26.43 is a flashing yellow light for value investors. You are undeniably paying top dollar for this equity today compared to what it historically costs.
Before we reveal the final verdict, we really need to understand the margin of safety. This is a core investing principle that tells us if we're actually getting a discount. Benjamin Graham famously championed this idea. Basically, you want to buy a dollar for 70 cents. That 30-cent buffer protects your portfolio from the unpredictable. So, the million-dollar question is, does EnerSys offer us that protective buffer right now?
Based on discounted cash flow metrics, EnerSys has a negative margin of safety of 13.96%, meaning it's currently trading at a premium, not a discount. In fact, if we look at margin of safety based strictly on earnings per share rather than free cash flow, that negative margin drops even further to minus 37.52%. Either way you slice it, the market has thoroughly recognized the high quality of this business and priced it accordingly.
Putting the numbers head-to-head, the current stock price is riding high at $213.26, while the underlying cash flows suggest a fair value of only $187.14. It's trading just a fraction of a percent below its 52-week absolute high. Make no mistake, you are buying a stellar, incredibly well-run company here, but you're buying it at a moment when maximum optimism is already entirely baked into the stock price.
As we wrap up this explainer, I want to leave you with this data-backed dilemma. With incredible historical returns and flawless financials, are you willing to pay a premium price today for tomorrow's potential? It is the classic battle between buying a wonderful business at a fair price versus waiting for a margin of safety that, frankly, may never return. The data is clear, the fundamentals are rock solid, but the price is undoubtedly hot. Thanks for joining me for this breakdown. Take these metrics, apply them to your own strategy, and keep learning.